Andrew Keen, CEO and President of AlphaShark.com. Today we're going to go through the next part of your Option Education 101. This is called covered calls. So what this is selling upside calls against a long stock position. We're going to give you two examples here, one in Microsoft, one in Apple. This is a great strategy if you're kind of a buy and hold investor where you think a stock can go higher, stay flat, or actually move a little lower. This is the only position the SEC and the OCC has said is non-speculative. So what we're going to talk about today is covered, even though that looks like a G, covered calls. And what covered calls are is combining long stock with selling, and usually it's upside calls. Could be downside, but upside calls, okay? There's two reasons to do this. Reason number one, you can get an extra percentage ROI, return on investment. Or you can look at it as number two, you lower cost basis, okay? So let's say you're long a stock and you say, hey, if it hits this level, I'd be out of my position. So we're gonna use a perfect example here in Microsoft. So let's say Microsoft, which is current price, is trading around $66. And you said, hey, I like Microsoft, but it hit 70, I would sell that stock at $70. Well, I look at the option market, and against your long stock, you could sell January 2018 70 call, okay? You can get $2.50. So we talked about owning calls, okay? Calls are the right but not obligation to buy stock at a certain level by a certain expiration, okay? This is selling somebody else that right, okay? So if I'm long stock, I'm saying, hey, if Microsoft goes to $70, instead of selling somebody my stock at 70, I could sell them the call option because that's going to give me a better ROI. There's two ways to look at this, okay? Number one, if Microsoft stays at this level, you're going to capture this $2.50, which is going to give you about a 3.6 return ROI between now and January, okay? So if Microsoft stays exactly here or moves higher, you're going to get a better ROI. Or number two, lowering your cost basis. If you sell the right to that option for $2.50, you're lowering your basis on the stock. You're lowering this to $63.50. Okay? So why use this strategy? Why not use this strategy? Covered calls are a great strategy if you want to sell your stock higher. Someone might say, well, what about if the stock goes to $90? Well, if you think Microsoft's going to go parabolic to 90, then you're not going to sell covered calls. So you're long stock and you're going to sell a covered call. Two reasons is you're going to increase your ROI, return on investment, or you could say you're going to lower your cost basis on the stock. So this is a good strategy if you think the stock is going to stay flat, move a little bit higher, a little bit lower. If I thought I was going to go parabolic higher, there's a different option strategy. Remember, traders, there's 27 option strategies. This is a great way to trade Microsoft if I thought it was going to be flat, a little higher, a little lower between January expiration. We're going to give up one more example here, and we're going to use everybody's favorite, Apple, okay? And how you determine which strike you want to sell the strike of where you think the stock could go. So if I thought Microsoft could go to 80, I'm going to get less premium for that option, but that's where I think the stock's going to go. That's the strike I want to sell. If I think it's only going to 70, I want to sell the 70 strike. If I think it's going to 100, I want to sell the 100 strike, okay? So make sure you sell whatever covered call of where you think the stock can go. Apple, currently trading $145, okay? Let's say I think Apple can go to 160. If I was just long stock at 145 and it goes to 160, that's a $15 return, which is about 10%. But in using the option market and using the covered call strategy, I can magnify my ROI. I could sell the January 2018 160 call, and I just looked it up for $6. Okay? So if I'm willing to sell my stock at $160, why would I not go and sell these calls? Okay? If I thought the stock was going to go to 180, I'm going to want to sell the 180s. Okay? So the two ways we can look at this. Number one, increasing my ROI. And number 2, we talked about lowering cost basis. Okay? So if hypothetically speaking, Apple closes at $160 on expiration of January 2018. My first example, if I was just long stock, okay, 145 to 160, $15 return, about a 10% return. However, magnifying the ROI, giving somebody else the right to buy Apple at the 160 strike between now and January expiration, I'm going to get an extra $6. This extra $6 is going to increase my ROI about 4%. So on stock, I would get 10% ROI. Using the covered call strategy, I would get 16% ROI. If I'm long stock, simple and easy. Stock goes higher, profit goes higher. Stock goes lower, profit goes lower. But since I captured this $6, I'm actually lowering my cost basis on my Apple stock to the 145 minus $6, which is 139. Okay? So Apple can actually drop from 145 to 139, and I can still make money on this trade, guys, okay? So upsides and downsides, advantages and disadvantages, okay? Covered calls, let's talk about what they are again. A covered call is shorting a call against a long stock position. You might say, AK, it's too good to be true. I can increase my ROI and I'm lowering my cost basis. But you say to yourself, well, what about if Apple went to 200? If I'm long stock, I'll never be taken out of that stock at 160. So there's upside and there's downside. The upside with covered calls, and when I want to use a covered call strategy, if I think the stock's going to move lower a little bit, flat, and grind higher is the best situation. If I thought the stock was going to have huge volatility, if I thought Apple had a chance to go to 200 or 100, I don't want to use this strategy. This is really good in a low volatile environment. I'm increasing my ROI and also lowering my stock basis. I lowered it here for 145. Just remember a couple things, guys. Number 1, you can increase your ROI, return on investment. Number 2, you can lower your cost basis on stock by using covered call strategies. Number 3, you're only going to do this strategy if you think the stock's going to grind higher. Number 4, you want to sell the strike of where you think Apple can go. So if I thought Apple could go to 180, I'm going to want to sell the 180s. I'm not going to want to sell the 160s. And number 5, guys, remember I can't close this option out anytime before expiration, but this is the only position that the OCC and the SEC has said is a non-speculative trade. Covered calls, guys, combining long stock with a short call. This is Andrew Keene, President and CEO of AlphaShark.com. Option Education 101 is learning covered call strategies. Thanks, guys. We'll see you next week. Make sure to visit AlphaShark.com for all my trades on earnings, unusual option activity, and more. But most importantly, follow me on social.